Ladies and gentlemen, thank you for joining me today as we take a detailed look at the latest developments on Wall Street and what they mean for investors. CNBC reported on November 3, 2025, that the market showed mixed results on Monday, with the S&P 500 rising modestly by 0.2%, the Nasdaq Composite gaining roughly 0.5%, and the Dow Jones Industrial Average slipping about 0.5%. This combination of modest gains and small losses highlights the underlying tension in today's market. While headline indices move higher, the story beneath the surface is far more nuanced. Many stocks outside of megacap technology are trading lower, signaling a narrow rally dependent on a few market leaders, as PBS emphasized in their coverage. Amazon is a perfect example. Its shares jumped more than 4% after announcing a multi-billion-dollar AI and cloud deal with OpenAI. This deal strengthens its technological infrastructure and reinforces investor confidence in AI adoption, according to Yahoo Finance. Nvidia also gained over 2% after the U.S. government announced restrictions on its most advanced AI chips, which paradoxically increased investor confidence in the company's critical role in AI infrastructure, as Yahoo Finance reported. Meanwhile, other sectors struggled. Kimberly-Clark saw its shares fall more than 14% following its planned $40 billion acquisition of Kenvue. This move introduced short-term uncertainty and market volatility, highlighting the uneven nature of the rally, as PBS noted. This divergence between market leaders and the broader stock universe is significant. CNBC reported that while major indices posted gains, the majority of individual stocks declined, highlighting weak market breadth and raising concerns about the sustainability of the current rally. Narrow rallies like this are typically driven by investor concentration in a few high-performing sectors. AI and cloud-related technology stocks carry most of the market's momentum, while industrials, consumer goods, and traditional healthcare struggle to participate, PBS emphasized. Macro factors also weigh heavily on sentiment. CNBC notes that the ongoing partial government shutdown has delayed key economic data, while investors await clarity from the Federal Reserve regarding the path of interest rates and monetary policy. Uncertainty around consumer confidence, manufacturing indices, and employment reports has shifted focus toward corporate earnings as the primary gauge of market health. This trend further concentrates attention on companies with strong AI narratives, such as Amazon and Nvidia, according to Yahoo Finance. The disparity between sectors is stark. Technology stocks flourish, while industrials and consumer-focused companies experience slower growth and margin pressures. PBS highlighted this divergence as a key feature of today's market. Market breadth is a critical metric in these conditions. Healthy rallies typically feature broad participation, but currently, a narrow group of stocks is carrying most of the weight, CNBC points out. Leverage and derivatives add another layer of complexity. Many investors use margin or option strategies to amplify returns, which can increase volatility if sentiment shifts suddenly, especially in a market dominated by a handful of leaders, according to PBS. Looking ahead, three key areas warrant close attention. First, earnings surprises across non-AI sectors. Second, market breadth to see if more stocks begin participating. And third, macroeconomic developments, including interest rates and fiscal policy, as CNBC advises. If industrials or healthcare companies report stronger than expected earnings, it could broaden the rally beyond technology, signaling a healthier market. Conversely, disappointing results could reinforce the narrow leadership trend, as PBS reports. Investors should watch sector rotation closely. Money flows heavily into AI and technology, lifting specific stocks while leaving others behind, Yahoo Finance emphasizes. Understanding this flow helps anticipate where gains and risks may concentrate. Headline index moves don't tell the full story. Even if the Nasdaq or S&P 500 shows gains, the underlying market can be weak, and many stocks may still be declining, CNBC notes. Corporate actions significantly influence sentiment. Acquisitions, mergers, and partnerships, like Amazon/OpenAI or Kimberly-Clark/Kenvue, can affect sector dynamics and volatility, sometimes disproportionately influencing broader indices, as PBS reports. Patience and risk management are critical. Even as the market rises, understanding which stocks are driving gains and ensuring investments align with long-term strategy is essential, Yahoo Finance advises. Valuations remain a central consideration. Many AI-related and mega-cap tech stocks trade at elevated multiples, increasing risk if growth expectations are not met, as PBS points out. Liquidity and capital flows also shape market behavior. Concentration of capital in a few stocks means sudden sell-offs could create amplified market reactions, particularly if leveraged positions unwind quickly, CNBC emphasizes. Beyond individual stocks, macroeconomic developments remain vital. Delays in economic data, such as inflation reports, employment numbers, or manufacturing indices, can trigger volatility and influence investor sentiment, PBS notes. Interest rate expectations continue to impact valuations, particularly for growth and technology companies. Small changes in rates can have outsized effects on investor expectations and market momentum, CNBC reports. From a strategic perspective, risk management is non-negotiable. Stop-loss strategies, position sizing, and diversification are tools that can help mitigate sudden shocks in a narrow market. The market environment today illustrates selective growth. Understanding which companies are leading, why they are leading, and how macro and sector factors interact is critical for investors seeking sustainable returns. Patience is essential. Investors should avoid chasing headline gains without understanding fundamentals. Narrow rallies can reverse quickly if sentiment changes. Long-term trends, including AI adoption, cloud infrastructure expansion, and technology integration, offer structural growth opportunities. At the same time, these trends carry risk due to elevated expectations and valuations, Yahoo Finance emphasizes. Capital allocation decisions must balance potential upside with the fragility of market breadth and concentration of flows, CNBC notes. Sector rotation and diversification are vital for managing risk in a concentrated market, while monitoring earnings surprises across industries identifies emerging opportunities, as PBS reports. Volume trends are another important indicator. High trading volumes in technology leaders suggest strong investor conviction, whereas weak participation elsewhere may indicate fragile sentiment, CNBC highlights. The rise of AI darlings also shapes market psychology. Focusing solely on megacap performance can create FOMO, driving increased volatility, as PBS reports. Earnings guidance and analyst revisions play a key role in shaping market expectations. Strong results outside of technology could encourage broader participation and stabilize the rally. Macro surprises, such as unexpected Fed announcements or geopolitical developments, could quickly alter market sentiment and trigger sharp moves in both directions, CNBC emphasizes. Even small changes in interest rates or inflation expectations can disproportionately impact valuations for growth and tech companies, highlighting the need for vigilance. For investors, maintaining discipline in a narrow rally is crucial. Stop-loss strategies, hedges, and diversification provide protection against sudden shocks while allowing participation in structural growth areas, Yahoo Finance notes. The current market reflects a balance of opportunity and caution. AI-focused technology companies lead the way, but narrow breadth, macro uncertainty, and elevated valuations require careful navigation, PBS emphasizes. Investors should remain selective, monitor macro trends, watch sector rotation, and manage risk proactively to navigate this environment effectively, CNBC advises. Finally, viewers should remember that headline index gains do not reflect the entire market. True insight comes from understanding sector participation, corporate fundamentals, and macro interactions, Yahoo Finance emphasizes. Opportunities exist, but caution is warranted. AI-focused companies are leading today, but broader market participation will determine whether this rally is sustainable over the medium term, PBS reports. Patience, vigilance, and informed decision-making remain investors' best allies as market developments continue to unfold in the weeks ahead. Thank you for following along. We will continue to provide detailed coverage of market trends, sector performance, and earnings developments, helping investors navigate the stock market with clarity, context, and confidence, as reported by CNBC, Yahoo Finance, and PBS on November 3, 2025.